Welcome on this video by Volatility. I want to talk today about the divergence between spot and volatility. So here we have the charts services. In charts, we have 1 minute snapshots of, at the top, SPX prices, at the bottom, implied vol index, so IVX. Now note that the IVX is available on all optionable stocks, indices and ETFs, and obviously you can have up to 8 charts in one page, so that allows you to sort of get an understanding of exactly what's happening. Now obviously, as I always say, spot gives you one picture, one market, that's traded through ETFs, through futures, through stocks, and the vol market gives you another picture. And sometimes, when both diverge, when they agree, everything is fine in general, but when they sort of disagree, it may be interesting to consider your options at this level. And so what I want to show you today is a situation where spot and vol disagreed and how it was resolved by a bounce into the close in spot. So let me move to Paint so I can do some drawings onto the chart, and I can show you exactly what I mean. Okay, so the first thing I want to show you is, let me just grab a pen. Okay, so the first thing I want to show you is, obviously we have a market that opens around 46.30, which we then rally all the way to 60, and at this point here we can see that we make a low around 16.6 in the IV market, and spot trades all the way to 60. I think 63 was the high. We then have a move down, and we reach 46.25, and IV reaches, on the other hand, around 18. So we get to 18 on IV. Next thing we have this move higher, back up. We reach about 40 something, 48, right? And IV gets back to this level. So that's the first thing that I want you to notice. The spot, last time IV was sort of in this, this area, right? The spot was trading around 63. So last time we got to this level, the spot was trading in between 60 and 63. That was this point and that point. After the sort of the first consolidation move in spot, after this big move down in spot, right, we have a bounce. And with that bounce, IV gets all the way back to the sort of lows on the day, whereas spot doesn't even get close. Spot is still 12, 13 points below the day's high. So that's already giving you some form of a strong signal that, spot and vol are saying different stories. The spot market is still slightly heavy, but the vol market is getting very comfortable. The vol market is getting very comfortable with the idea that, we may not have a very aggressive move. And that may be simply triggered by the fact that, we have a first attempt at 30 and we have a second attempt at 30 again here. And when we have this second attempt at 30, the market just doesn't break through and just trades back up. So we have this normal rangy behavior where we establish a support and we respect that support once, twice, and then the vol market, which would get concerned if obviously we had a prolonged movement, the vol market just decides that it's all fine and well and stabilizes. Then we have this divergence again where we see spot moving down and the vol market remaining flat. So again, volatility doesn't really react up until we have this acceleration, even though we are making new lows. We are not seeing the same thing or barely seeing the same thing on the IV. And so we have very little reaction. We have generally a sideline trading price action in the vol and a downward trend in the spot market. It's only when we see this acceleration, much steeper acceleration, and then IV starts to react. But here again, we make new lows. We trade all the way to 15, but IV doesn't even break the previous highs. The IV stops at 17.8. So we have this move down aggressively. We break the lows in spot. It's a very strong signal. We break the lows in spot, but we don't break the highs in IV. So here again, the implied vol market is telling you that it's still seeing this move as a move within a rangy market. There is no anomaly, there is no panic, there is no full-fledged worries about, the market just collapsing. No, it's just a normal market. Sellers are in control, they're pushing spot prices down, but at some stage, the vol market is expecting, that's the most likely outcome that we're seeing being priced in the market. The vol market is expecting that, things will sort of normalize and buyer will step in. Now, obviously, it's not 100%. Sometimes the vol market will get it right, sometimes it will get it wrong. But it's something, I suppose, if you have a list of indicators that you use when you trade intraday, it's an extra way to see the market, and it's a vision that very few people can have, because accessing this information, until now at least, until we developed charts, was quite difficult. It was difficult to get access to this information, especially if you want to get access to that information on multiple indices, because obviously You have some specific vol indices that you can look at, but those have constructions which can be very complicated, first, and then second, you don't have them on all underlyings. You don't have them on, like, single stocks, for example. And so if we wanted to replicate that analysis on stocks, we could obviously do it as well. So it's quite a powerful indicator. And then we see that from that point, IV starts to come off, vols, spot, like, it trades sort of sideways, and then it starts to go back up, and both move in tandem as well up until the end of the day, where you have like a strong move up in spot, a strong move down in vol. But I think what really matters was the fact to some degree that the IV market was already sort of telling you, like, from that point that we made here, he was telling you, the IV market, that it was in a downtrend, and the spot market wasn't really giving you the same signal. Like, you had this big divergence up until that point. We had big divergence between spot and vol, and so we know that at some point, that divergence is going to get resolved. It could get resolved by, spot moving back up and vol continuing to move back down, or spot moving lower in a faster manner, and the IV market then catching up aggressively and compensating for that. So it's not like one-to-one. It's not like you see this in the market and then you just come in and you start trading spot against it. But I thought, like, it was quite an interesting. An interesting observation to make, and I'm sure there are plenty others that could be made. So I hope you found this useful, and I'll see you for another video. If you liked it, please leave a thumbs up, and don't hesitate to subscribe to the channel. Bye bye.